Hello traders, you're welcome to this video on the institutional trading strategy. Many traders enter the market with the belief that price is random or controlled by indicators, but the truth is that institutions, that is the banks, hedge funds, and large financial firms, are the ones shaping price movements. Their orders are so large that they influence liquidity and direction. Okay. And understanding how they trade is the key to reading the market correctly. So, what exactly is institutional trading? It is the way big players move in and out of the market with huge positions. Okay, so they can't just enter with a single click like retail traders. Instead, they need liquidity. They look for areas where many stop losses are clustered or where retail traders are entering in the wrong direction. By targeting these areas, institutions create the liquidity they need to fill their orders. This is why you often see stop hunts or sudden spikes before the real move begins. Now, let us go through the main components of an institutional trading strategy. The first is market structure. Okay, institutions pay close attention to higher highs and higher lows, right? Or let's say higher highs, that's in a bullish trend, they pay attention to higher highs, all right? Lower lows, right? And the overall direction of the trend, right? Whether the market is trending upwards or trending downwards, right? So market structure tells the story of price and reveals where momentum is shifting. In a bullish trend, you usually have higher highs and higher lows, showing you that the market is going upward. The trend is bullish. Okay. In a bearish trend, you will have lower highs and lower lows, telling you that the trend is bearish. Okay. The second component is order blocks. These are zones where institutions have previously placed large orders. So in order to identify an order block, you just have to look for a break of structure. In a bearish trend, when price forms a lower low like this, right? And then price breaks that lower low. You can see this particular low now. As price breaks it, the order block is now going to be the last bullish candle before that impulsive move. All right. So that gives us, a bearish order block around here. Okay. So in the case of a bullish order block, let's look for an example. So price breaks above, okay, let's use this now. Price breaks above this high, right? Is a high. Now the last bearish candle before that break happened was this, right? Giving us a bullish order block. So when price returns to these areas, it often reacts strongly, right? You can see price eventually came to test this, to tap into this order block around here. You can see I just extended it now, and you can see that price came and tapped into it and went upwards. Okay, so you could either see a reversal, or a continuation in the same direction. Whenever price breaks another block and tests it and continues downward, it means that's turned into a breaker block. Okay, So it's either price gets rejected from that order block, or probably it breaks the order block and perhaps turn it into a breaker block. Okay, so learning how to identify order blocks helps you understand where the smart money is active. The third component is liquidity zones. Liquidity zones are levels where many traders have stop losses or pending orders. You can be able to know where a liquidity zone is just by being a normal trader, right? You know that when you set a sell limit around the resistance zone, most likely your stop loss will be some pips above that resistance, right? That's what many retail traders think. Okay, because of that, we have a liquidity pool around there, because smart money knows that retail traders usually set their stop losses above resistance, below supports and all of that. So we have liquidity zones around those levels. Okay, so institutions target these zones to trigger liquidity and then push price in the opposite direction. It is why retail traders often feel like the market is moving against them right after they enter. So now you understand the reason why, right? The fourth is manipulation phases. Before a major move, institutions often push price in the opposite direction to trap traders. Once enough liquidity is captured, they shift price back in their intended direction. So recognizing this manipulation helps you avoid false entries and stay aligned with the smart money. Okay, so how do you apply all this in your own trading now? How do you apply all this in your own trading? You have to start by marking the structure on your charts. Okay, so you have to mark, the structure on your charts. You look for recent highs and lows, right? Look for recent highs and lows to to identify where liquidity is resting. Okay, then you highlight order blocks and key zones. Okay, you look for recent highs and lows. Recent highs and lows, remember, emphasis on recent highs and lows. So once you identify your recent highs and lows, then you mark your order block just like I explained. Once you have a break of structure, you look for the last bullish candle. If it's a break of structure to the upside, you look for the last bearish candle. If it's a break of structure to the downside, look for the last bullish candle. Okay, highlight your order blocks and key zones where price has reacted before. When you see price sweeping liquidity and then respecting an order block, that's often the footprint of institutional activity. Now, here are a few important tips when using the institutional trading strategy. First of all, be patient. All right, because institutions don't move the market every minute. Okay, so wait for clear setups, right? And then, secondly, use confirmation. Okay, do not jump into a trade just because price touched a zone. Okay, you have to wait for rejection or structural shifts, and then avoid chasing price. Institutions want you to chase so that they can trap you, but if you stay disciplined, you begin to see the real moves forming. So by now you should have a clear understanding of what institutional trading is and how the institutional trading strategy works. You've learned about market structure, order blocks, liquidity zones, and manipulation phases. More importantly, you know how to begin applying this knowledge to your charts. If this video gave you clarity on how institutions move the market, make sure to hit the like button and subscribe for more strategies and tutorials that break down trading step by step. Share this with other traders who want to understand how smart money operates. Okay, thank you for watching, and I'll see you in the next video. Happy trading.